studying your last two. I swim med tea when they turned in. The styren down to mute. And can learn the pole that sunk he died.
One of the biggest mistakes in year-end tax planning is assuming that bonus planning ends once the bonus has been declared. In reality, successful bonus planning is really date planning. The difference between a successful bonus strategy and a failed bonus strategy often comes down to whether the right dates were identified, monitored, and followed. This slide illustrates the 4 critical dates that every tax preparer should track. The process begins at the corporate year-end. This is the point where the corporation's financial results are reviewed and decisions are made regarding compensation planning. Taxable income is analyzed. Potential bonus amounts are considered, and planning opportunities are identified. The next important date is the bonus declaration date. At this stage, a formal decision is made to pay the bonus. A resolution may be prepared, and a bonus payable is recorded in the accounting records. The corporation has now created an obligation to pay compensation. However, this is where many people incorrectly believe the process is finished. A declared bonus is not the same as a paid bonus. The third and most critical date is the bonus payment date. This is the date when the employee or owner-manager actually receives the money. The payment is processed through payroll, deductions are calculated, and compensation is formally delivered to the recipient. This is the step that transforms a planned bonus into a completed bonus. Without this payment, the planning strategy remains incomplete. The final major date is the payroll remittance deadline. Once the bonus has been paid and payroll deductions have been withheld, those amounts must be remitted to the Canada Revenue Agency by the required deadline. Proper remittance is just as important as proper payment. Notice the warning highlighted on the slide. Declaring a bonus does not complete the process. The payment must actually occur. This may sound obvious, but in practice many bonus problems arise because a bonus was declared, recorded, and discussed, but nobody ensured that the payment was actually made. This is why experienced practitioners actively monitor payment dates rather than focusing only on tax deductions. A good tax planner calculates the deduction. A great tax professional tracks the execution. They know the key dates. They plan ahead. They monitor deadlines. And they verify that both the payment and the remittance actually occur. The lesson from this slide is simple but extremely important. Tax planning creates the opportunity. Execution creates the result. And successful execution begins by carefully managing the dates that drive the entire bonus process. Understanding bonus planning is important, but successful tax planning ultimately depends on execution. A bonus strategy only works when the bonus is actually paid correctly and on time. This slide illustrates the professional execution process that tax preparers should follow to ensure a bonus moves successfully from planning to completion. The process begins by determining the bonus amount. At this stage, the corporation's financial results are reviewed, taxable income is analyzed, and the desired compensation amount is calculated. The objective is to determine a bonus that supports the overall tax planning strategy while remaining financially appropriate for the corporation. Once the amount has been established, the next step is preparing the bonus resolution. This formal document records the corporation's decision to pay the bonus and creates the supporting documentation that will be needed for accounting and tax purposes. After the bonus has been approved, attention shifts to scheduling the payment date. This is one of the most important steps in the entire process. Rather than waiting until the last minute, professionals choose a payment date well before any critical deadline. Calendar reminders are created, follow-up procedures are established, and the payment date is added to the year-end planning checklist. Good practitioners never rely on memory when compliance deadlines are involved. Next comes payroll processing. The bonus is entered into the payroll system. Payroll calculations are performed, and the required deductions are determined. Income tax, CPP contributions, and any other applicable payroll deductions are calculated at this stage. Once payroll processing is complete, the actual payment is issued. This may occur through direct deposit, check, or another approved payment method. The important point is that the money must actually leave the corporation and reach the employee or owner-manager. This is the moment when the bonus becomes a completed payment rather than merely a planned payment. After payment has been made, source deductions must be remitted. The corporation must remit income tax withholdings, CPP contributions, and any other required payroll deductions to the Canada Revenue Agency according to the applicable deadlines. Failure to remit deductions properly can create penalties and interest even if the bonus itself was paid correctly. The final step is documenting completion. Payroll reports should be saved, payment confirmations retained, remittance records preserved, and year-end files updated. Proper documentation provides evidence that every stage of the process was completed successfully. Notice the key message at the bottom of the slide. A bonus is not complete until the money leaves the corporation and reaches the recipient. This statement captures the essence of bonus administration. Many bonus planning problems occur because practitioners focus heavily on calculations and deductions, but fail to verify that the payment was actually processed. Professional tax preparers take a different approach. They plan the bonus. They schedule the payment. They process payroll. They verify payment. They confirm remittances. And they document completion. When all of these steps are followed consistently, bonus planning becomes reliable, compliant, and effective. That is the difference between simply creating a tax plan and successfully executing one. Even the best tax planning strategy can fail if the administrative process breaks down. In fact, many bonus-related problems are not caused by complicated tax rules. They are caused by simple execution failures that could have been prevented with proper systems and follow-up procedures. This slide highlights some of the most common reasons bonus plans fail and how experienced professionals prevent those failures. Let's begin with the first and perhaps most common problem. A bonus is declared but never paid. The corporation prepares the bonus resolution, records the bonus payable, and discusses the tax deduction. Everyone assumes the process is complete. Months later, someone discovers that the payment was never actually made. The tax planning looked successful on paper, but the execution never happened. Another common problem is waiting until the last minute. The closer a business gets to a deadline, the greater the chance of errors, delays, and missed requirements. Payroll processing takes time. Approvals take time. Banking transactions take time. Professional practitioners avoid this risk by scheduling payments well before critical deadlines. A third problem occurs when payroll is processed incorrectly. The wrong bonus amount may be entered. Deductions may be calculated incorrectly. Payroll coding errors may occur. Small mistakes at the data entry stage can create significant reporting and compliance issues later. Source deductions are another area where problems frequently arise. Sometimes the bonus is paid, but the related payroll deductions are not remitted on time. This can lead to penalties, interest charges, and unnecessary CRA attention. Then there is the issue of poor follow-up. Many administrative failures happen simply because nobody was responsible for tracking the process from beginning to end. Without reminders, checklists, and accountability, important tasks can easily be overlooked. Now let's look at how professionals prevent these problems. The first step is scheduling the payment date immediately. Rather than simply discussing a future payment, professionals place the payment date on the calendar, create reminders, and establish clear deadlines. Next, they implement a follow-up tracking system. Every bonus payment becomes a tracked task with specific responsibilities, deadlines, and completion requirements. They also use payroll processing checklists. Checklists ensure that bonus amounts are entered correctly, deductions are reviewed, payroll is approved, and all required steps are completed consistently. Another important safeguard is remittance tracking. Professionals monitor CRA remittance deadlines and confirm that deductions have actually been remitted. They do not assume the payment was made. They verify it. Finally, they perform payment verification. This means confirming that the payment left the corporation and was actually received by the intended recipient. Notice the comparison at the bottom of the slide. The reactive approach says, "I hope it gets done." The professional approach says, "Track it until it is done." That single difference explains why experienced practitioners encounter fewer compliance problems and achieve more consistent results. The key lesson from this slide is that successful bonus planning requires more than calculations and tax knowledge. It requires planning, tracking, execution, and verification. Tax planning creates the strategy. Professional administration ensures the strategy actually works. And that is ultimately what separates successful practitioners from those who continually deal with avoidable compliance problems.